What do you think is the connection between investor friendliness and debt transparency? Why do they go hand in hand? Because this is a report
Correct.
which measures both.
Correct.
But obviously, debt transparency as a isolated concept doesn't mean anything.
Yeah.
No,
Yeah.
the result is investor friendliness.
Yeah.
So how does that feed into this?
So there are normally the financial system is interconnected, and what happens is, like, when you are having where your rankings go up in one thing has an impact on the other. One thing is when you do an investment, but what you do is you basically do the risk premiums. No? So with this, what happens is Sri Lanka's investment grade and plus the risk premium will come down. So when the risk premium comes down, what happens is, things like cost of finance comes down, right? Then for investors, the risk of investing. I mean, so normally risk can be categorized in so many ways, right? So this one particular category on risk is going to have positive impact on the country. So that's how the whole thing is connected with. One thing is the cost of finance. Other one is the investment being the country being more investor friendly, because when we say investor friendly, is they only look at one category, right? It's not like that. So what happens is, like, when anyone comes to invest, what they do is they do a risk profile, right? And they work out the premium, saying that, okay, if I'm coming into this country, sorry about that. When I come into this country, the risk is, let's say risk is X, right? That means I need a return of, for example, this much, a return of Y to make it feasible, right? So the less the risk goes down, what happens is then the return also what they're looking at, the super return what they're looking at is also coming down, right? So then what happens is it becomes more investor friendly, because the reason is then there are more people who will look at this. So that is like my take on the whole thing.
Yeah, so adding into what Riyad said, Chari, so risk premium can be multiple things. It can be the exchange rate risk, it can be the inflation risk, it can be the political risk. So basically, let's say the government is issuing a bond, for an example. So we are saying, okay, we are issuing a bond. Each bond is, let's say, $100 each. And if there's higher risk, people will buy this bond probably at about, let's say, 80 or 85 or 70.
Yeah.
Right. So that's the margin from 75 to 100, because our face value of the bond is 100. But actually the people who are willing to buy this bond only are willing to pay about $70. So what happens is they buy the dollar at 70, but they buy the bond at $70, but they get an interest in every 6 months for $100. And at the maturity, when they come with that small note, whoever the issuing party is agreed to pay $100. So
that's a zero coupon.
That's a zero coupon. So that's but when the risk premiums are lower, means that the market doesn't see that there is a higher risk, and risk can be brought down when you're transparent, because then you can see how much do we owe, to whom, in what currency breakdown, and what's our spread, like what's the maturity cycle, and what's the cost of financing. Everything can be, basically, people can see who are investing. So then it's easier for them to make decisions. So as a result, your risk premium can be basically brought down. Even, of course, you may have all sorts of risks, exchange rate risk and other risk factors, inflation risk. But at least it's transparent. So you don't have to cost for unambiguity, because you know the details beforehand. So with that transparency, I think our numbers have improved, and that's why I think this index have shown brought us up to the main top 4 in the emerging markets category.
And the other one is that it sends the right signals to the market, saying that, one thing is, the transparency. That means the government is, they're being very transparent on what they do, right? And so in the capital markets, one thing markets hate is they don't like question marks, right? Because that's why sometimes they say bad news is actually better than
uncertainty. Lack of predictability.
Exactly. Because uncertainty, you don't know where the flow is. Bad news, you know where the flow is.
And you can account for that.
You can account for that.